Okay, we're going to get going in just a minute here. Welcome to the webinar. Thanks for coming, and just wait for just another 30 seconds or so, and then we will start the process. Okay, thanks for joining us for another episode in our Bridging the Gap Between Finance and Go-to-Market webinar series. Our topic today is how to master go-to-market data for due diligence, and our CEO, Scott Stauffer, has a lot of insights to share today, so we're going to get right into it. But before I pass it over to Scott, I just want to let everyone know that this episode will be recorded like all of our episodes, and you will get an email from Livestorm with the link to watch or share the replay when it's done. The main content of the webinar is going to run for about 30 minutes, but if you have questions, please throw them in the question or chat box on Livestorm here, and we'll get to them at the end. And with that, I'm going to turn it over to Scott to start to go through the agenda and then get things going.
Awesome. Thanks a lot, Dan. Thank you all for joining, and apologize in advance for the roughness of my voice. It is allergy season, though, so apologize. Anyway, the purpose of today's webinar is to provide you with some tips and best practices for assembling the necessary go-to-market data for a due diligence data room, either for an investment or an exit. We're going to start by discussing how go-to-market data is really one and the same as finance data, especially for businesses with recurring revenue models. We'll touch on the importance of having solid go-to-market data. And then the bulk of the time, we're going to go through 3 different items to prepare for your data room. And then finally, we'll talk about how to address this stuff depending on where your current maturity is. So if you think about why there is so much emphasis around properly reporting on financial performance, it's so that investors can determine the attractiveness of an investment. In legacy industries, that attractiveness of an investment was largely related to how much cash it would throw off or return to investors in the forms of dividends, and to a lesser degree, appreciation on the value of the stock price, which was driven by earnings per share. In the tech world, and in particular SaaS, the attractiveness of an investment is largely driven by revenue growth and the efficiency with which a company can achieve that growth. Revenue growth is determined, obviously, by your ability to add new customers while retaining or even expanding existing customers. Efficiency is tied to the cost of acquiring those new customers or retaining the existing ones. You've all likely heard of Rule of 40, which is a mathematical rule of thumb that investors use to value businesses. It's based on year-over-year revenue growth rates plus EBITDA as a percent of revenue. And then more recently, some people are casting about the term Rule of X, which recognizes the fact that while both growth and profitability are important, investors tend to value growth a bit higher. In any case, efficient growth is the name of the game. The data that describes a business's performance in acquiring and retaining customers and the efficiency with which it does that is traditionally thought of as go-to-market data. And traditionally, the owners of that data have been go-to-market functional leaders. Now, a substantial trend we're seeing is for finance to be taking ownership of this data, since they tend to have an unbiased perspective across the entire go-to-market motion, and the skill sets related to data models and analysis are more closely aligned with the expertise of the CFO and FP&A leaders rather than the go-to-market leaders. So having great go-to-market data and analytics arms the revenue leaders to take confident action that actually improves outcomes and valuations. Great go-to-market data helps the revenue leaders precisely understand what is working and what's not working and the why behind it, so that they can shift resources from the less productive activities to the ones that are more productive. It helps the revenue leaders understand which levers have what kind of impact. And as Aaron Levine, the CFO at Profix, recently said in one of our data room podcasts, This knowledge is what helps businesses focus on winning strategies rather than simply spray and pray. And improving outcomes alone does, in fact, impact valuations. But it goes beyond that. As Kelly Ford, managing director at Edison Partners, recently told me in another episode of the Data Room, the maturity of a business's go-to-market data is an indication of the sophistication and maturity of the leadership team. In her words, all things being equal, we might pay 7x to 8x ARR on the business that knows how they are making their numbers, and 4x to 5x on the less mature, less sophisticated operation. So this stuff is important, and it is important for the CFO to embrace it. So today's topic was how to master go-to-market data for PE due diligence. And I don't know that you'll leave this webinar with complete mastery of go-to-market data, but hopefully you'll leave here with some things to think about. And after the fact, you can get some of these data room templates that I'm going to walk through during the session. So I said earlier that the primary drivers of SaaS valuations are growth and efficiency of that growth. And ARR growth is simply the ARR at the end of a period compared to the ARR at the start of the period. You should always have an ARR waterfall, which depicts the components of the ARR growth. And there are really 4 components of growth. Positive growth from new logos, downsizing from churn and downgrades, and then growth from expansions, which could be native expansions, it could be upsells, could be cross-sells, etc. The churn, downgrade, and expansion components can all be lumped into net retention. So basically, you can think of growth as the sum of new logo ARR plus net ARR dollar retention on existing business. And those are the 2 components you will want to have robust data and models for. It is a deep understanding of how you are driving new logo acquisition, along with how you are achieving a positive net dollar retention on your existing business that investors are going to want to dig into. But just as importantly, having this understanding will help you manage your business better on an ongoing basis. And it's for this reason that I strongly encourage you to always have your diligence data room complete, because that should also be the data and models that drive your operational decision making. In fact, I'd argue that best practices for a CFO is to build their data room from day one, as if an investment or an exit opportunity can happen any day. And there's 2 benefits to doing this. One, it exposes the holes in your data and the holes in your instrumentation early, so you can actually take steps to fix this long before it's time for an investment or an exit. If you just ask any investment banker, the one thing they say is most often a challenge is getting the go-to-market diligence material together, mostly because these companies haven't set themselves up to have that. But the second benefit of doing this early is that having the data room material early on and being transparent about it with the rest of the C-suite helps keep people aligned on what really matters. So let's start by looking at new logo diligence. When you are seeking investment or exit, you will undoubtedly make some projections about what the future holds. You will likely show some hockey stick version of revenue growth, along with ever-increasing margins. But you'll need to be able to back those projections up. And you can't do that if you don't have really strong models of how your new logo acquisition strategies work. This is what we call full funnel models. Quite simply, these are the models that demonstrate how leads or contacts convert into deals. At their most basic, they explain where leads fall out along the process of becoming a customer, what we call conversion rates. And these models also explain how long it takes to move from a lead to a customer, what we call sales cycle times. Beyond the most basic funnel, though, if you have your instrumentation set up well, you can slice these models by channel as well as by segment And these different looks at new logo acquisition really help you dial in things like ICP and what's working and what's not. Now, the source of this data is predominantly the CRM, but it assumes solid data integration between the CRM and the marketing automation platform. And importantly, it requires that there be adequate processes in place to ensure that the required data actually gets populated. So let's take a look at an example of a funnel conversion model built by channel. And I'm going to share my screen here. Okay, do we see channel funnel conversion model? Yes. Okay, so on this first tab, let me explain what's going on. This particular company has 6 different channels or strategies, whatever you want to call them, that they use to source prospects and customers. AE and SDR prospecting, organic, search ads, LinkedIn ads, and trade shows. Each of these blocks is the funnel model for that strategy or that channel. And I'll just walk through one so that you understand what we're looking at. It starts with leads. Some portion of those leads in this company's process convert into initial discovery / qualification meetings that get set up. It's basically 2% of the leads convert into the scheduled initial discovery meetings. Of those scheduled meetings, 85% of them complete. So the rest would be no-shows, basically. Of those people that complete the initial discovery meeting, 25% of those are converted by the sales team into pipeline opportunities. And then you can see on down through each stage of opportunity how many or what percentage are converting and moving forward to the next stage. That's the left-hand side of the model. The right-hand side is the days it takes to move from each step. So it takes about this company about 16 days on average from the time they put a lead into a prospecting cadence to the time they actually get a meeting set up. It's about 11 days later that they actually have that meeting, 2 days later that they actually convert it to a pipeline op, and so on down. Then what you see here on line 10 is what the average deal size, this is in MRR for this company, the average deal size is for customers that are sourced through AE prospecting. The bottom 3 parts are on the left ratios. It's basically the inverse of the funnel conversion rate. So how many leads in AE prospecting does it take to get to a deal? 1,601. How many completed meetings does it take to get to a deal? 27. How many pipeline ops? 7. On the right-hand side is the combined aggregate number of days to get from lead to deal, from meeting held to deal, or pipeline op to deal. This is a funnel conversion model. This is one for a specific sourcing channel, and they have similar models for each of the sourcing channels. Where this data comes from is from historical actuals. And so it's very important that you be able to, that you effectively have your environment instrumented properly to produce the data to inform these models. So this is a funnel conversion model. I'll just briefly show you for grins, the exact same thing in Scale Matters software. Oh, maybe I won't. Give me just a second here. All right, sorry about that. It had logged out because I haven't looked at it since this morning. This will load, and I'm just showing you this so you can understand the different ways you can go about this, right? You can pull all these reports out of Salesforce or HubSpot and then export them and build them into these models, or there's software that automatically does it for you. So here you can see full funnels by each channel, from lead to deal, the ratios for how many leads it takes to get to a deal, meetings held to deal, and opportunities to deal. Doesn't really matter which way. Obviously, one's more efficient. The important thing is that you actually have the data nailed. So these funnel conversion models are instrumental in letting a leadership team, as well as prospective investors, vet assumptions in the go-forward plan. They're also instrumental in providing predictability beyond simply what a sales forecast is meant to do. And let's look at an example of using the model to predict new bookings. So I'm going to go to this tab called Channel Pipeline Pressure Test. And at the very top, this is all just input. So we went into the CRM and grabbed how many of each record there is for each type. So how many leads are currently open that are tagged with AE prospecting? How many of those are in first meeting set state, right? How many stage 3, stage 2 ops that are tagged with AE prospecting, and so on for each of the various strategies and each of the places on the funnel. That's the only work that needed to be done. Then the template, if I expand this, it automatically calculates based on the model, so based on historical norms, what should we expect in terms of deals and dollars and timeline and stuff. And so I'll just stick with AE prospecting. The way the model works, these 2,000 leads that are currently in lead state should produce about 1.25 deals worth 7,000 of MRR in roughly 66 days. These 15 that have first meeting scheduled should produce about half of a deal in 53 days, and so on down. And the model does the same calculations for each of the record types in each of the different channels. And then the summary of it is that you can look across everything that's currently in the CRM that says that between now and 15 days from now, we should be able to book about 7.2 deals worth 33,000 in MRR. And in the 15 days following that, another 9 deals worth 43K. So you see, the importance of having these funnel models is it actually becomes the basis for predictability in your organization. And from an investor perspective, it becomes the basis of how they're going to test whether your current pipeline is sufficient to meet what your near-term plan, go-forward plan is saying. So let me stop sharing and I'll go back to Dan. So you can see how these funnel conversion models are helpful, right, for the finance team as well as prospective investors to test the go-forward projections. But the data to inform these models, it doesn't just magically happen. And while you would think this is the data a CRM should naturally capture, it doesn't. This is where you need to be purposeful in defining the data model you will need and how you will get the supporting instrumentation, which is always kind of a combination of configuring the tech as well as having processes in place. This stuff requires a deep understanding of go-to-market, combined with deep expertise in data analytics, as well as go-to-market technology. And just as a shameless plug, this is exactly the type of work that Scale Matters does for our customers. So that's the look at new logo. It's all driven by this funnel conversion model from a diligence perspective. The revenue by customer cohort data room asset is the primary tool to understand retention dynamics. Remember on that waterfall, the first positive thing was new logo. We just dealt with that with the funnel conversion model. The next 3 things are all net dollar retention. That's what we're going to talk about now. The extent to which you build one of these models that allows slicing by various customer profile attributes, it also helps you validate your ICP. So from a diligence perspective, This is the tool investors will look at to help vet your assumption of what the go-forward net retention will be. The data for this asset can come from the CRM if you have properly set up your CRM and your processes in order to manage renewals and upsells and downsells. But if you haven't done that, and many companies haven't, then it will more likely be available in the ERP or subscription management software that you might use. And if you're fairly early on in your maturity, you may simply be tracking revenue recognition in spreadsheets. So let's look at an example. And I'm going to share my screen again. And now I am going to the customer cohort template. This is a pretty straightforward template, and every kind of investment banker will encourage you to have this. All this is on the very first tab is customer revenue by month. This is specifically the monthly recurring recognized revenue that you booked for this customer, that you recorded for this customer each month. And so you can see, customer one, which was, and this particular model starts January of 19, was $4,000, and they went, looks like in April of 20, they churned. So pretty simple model. You just have to capture the recognized recurring revenue each month for each customer. And they always will look like this because the later you go on, the less months you've had people. Now, we add in, and we encourage you to put the month the customer started with you, the quarter they started with you, and it's helpful to put in different attributes that are ICP profile attributes. In this case, we've just stubbed this template with some fake stuff, so you could kind of think of the column D as size attributes, right? Big, small, and medium. Color E, which makes no sense, is the column E is the color attribute, red, blue, green, and then there's a geographical attribute, North America, EMEA, and APAC. And the reason we want to do that is it allows you to look at retention data by ICP attributes, which allow you to better understand whether certain ICPs are better than others for you. So anyway, you put in all this data, which should be fairly straightforward for you to get, and the template automatically converts all the churn and retention data. So year over year is primarily what people are concerned about. So you see logo retention is automatically calculated down here, then gross dollar retention and net dollar retention. And by the way, there's a little funkiness, not in the model, but about gross dollar retention, because you have to determine what the basis for that gross dollar retention is. So there's these hidden rows in there that basically determine what the gross dollar retention basis is that existed 12 months prior to be compared against. But I'll just hide that for simplicity today. So that is the first tab, which basically gives you your aggregate look at logo retention, gross dollar retention, net dollar retention. The second tab sort of rearranges that data, basically extracts the data out of the first tab and puts it into time-based cohorts. And what this means, where the top of the first tab was calendar months, the top of the second tab is relative sequential quarters. So Q1 means the first quarter that a customer was with us, regardless of what calendar quarter and what year that was. It's the first quarter they were with us. Q2 is the second quarter they were with us. And so this part of the template basically sums all that stuff up, and it will always look like this, a kind of a reverse left to right wedge. and then it provides summary net dollar retention across the entire population. And what you're looking for ideally is it helps you understand kind of over a 3-year period or 4-year period what percentage of the original amount people were coming in at, where are they likely to be. And then the bottom part of this just does it on an individual customer basis relative to creation. So in any given quarter, this cohort, let's say in the 10th quarter, the Q1 19 cohort was down to 62% of what their original revenue size is. So it starts to give you a really good understanding of any dynamics going on in retention. When you look at this particular chart, what you would like to see is numbers increasing as you go down. As you go down, you're dealing with more current customers. You would like to see that your retention strategies are working to improve retention. So you think about customers you brought in early 21-19. Maybe you didn't have a very good customer success organization. You didn't really understand how to push adoption properly, et cetera. But over time, as you get more customers, you're learning how to make these customers very successful and extract value out of their product. You would like to see an increase in the retention as you scan down on this chart. We aren't seeing that on this, but that's because this is fake data. But it's an important thing that people will look for, is to understand whether you're getting better at delivering value to your customers or not. And then the last tab is simply a pass on this using one of those ICP attribute, which is the size one. So here we've basically reorganized the data showing big, medium, and small customers. And, the interesting thing here, this is where you're trying to understand if there are meaningful differences in the retention between different profiles of customers, right? Again, all very important information to help you really understand what your best ICP is. It typically, you would expect big, meaning enterprise, to have the highest retention. But interestingly, in this model, and of course it is fake data, but this is the type of thing you would look for, you actually see the net retention down here on SMB and is north of 100, where on enterprise it's mid-90s. So if this was real and I saw that, I'd say, maybe our product really isn't well suited to these enterprise guys. Not that 95 is bad, but it's obviously different than positive than over 100. So anyway, let me turn this back to Dan on the screen share, and then we'll talk about cost of acquisition. So we've talked about two things so far: new logo acquisition, the funnel conversion model, and then net retention and the customer cohort revenue model. Now what we want to do is talk about the efficiency. Remember, we mentioned rule of 40 and rule of X. Both of these valuations, rules of thumb, rely not just on growth, but also on profitability. So the last key thing we want to look at and have a good handle on is the efficiency of acquiring that growth, what we call customer acquisition costs, or CAC. And the source data for CAC models comes from cost data, which is typically found in an accounting system, along with kind of some behavioral observation data from sales leadership. And then we apply that cost data across the funnel conversion model to arrive at relative costs. If we go on to the next slide, Dan, since the cost of the sales team is often the biggest part of CAC, the first thing we want to do is have a model for attributing that cost to various parts of the funnel and kind of distinguishing that by channel. So I'm going to share one more time. And we're back in this channel funnel conversion model, but we're going to be looking at cost stuff. The first part of this model does the attribution of the cost of sales of the sales team. The stuff in red is data provided by the sales leadership team. They have observed and understand how much time each of their salespeople spends on these various steps and activities in various stages of the process. By populating this little matrix with that, the template automatically calculates, okay, for paid search as a strategy or channel, you will use about 38 hours of a salesperson's time to get a deal done, and the commission on that will be about $49.80. Again, you can modify. Let's say I want to look at AE prospecting instead of paid search. There, it's substantially more, right? Because paid search, people are coming in with some intent. Here, it's 63 hours sales time and $67.50 of commission. So you take that data of which is basically attributing the cost of sales, and then you go to channel CAC. And here in this model, and I know I'm blasting through this stuff, so if any of you guys are interested in this model, we will make it available, and we'll put some Zeit videos on it just to explain it at a more tempered pace. But we've duplicated the funnel conversion model stuff here. There's some additional inputs, which is cost per lead stuff, which accounting and marketing should have. But then the model basically ends up calculating top of funnel costs, bottom of funnel costs, and you end up with a total cost to acquire a deal for each sourcing strategy and a total cost per dollar of ARR for each sourcing strategy. And in this example, I look at it and I'd say, okay, well, cost per dollar of ARR, which is the one I really care about, 18, 15, 16, 17. 4 of these channels are all pretty similar in terms of their efficiency: AE prospecting, organic search ads, and LinkedIn ads. But SDR prospecting and trade shows are materially worse. So I would need to have a very good reason to keep investing in those. Now, trade shows might be very brand oriented, which is important, right? But anyways, this is what you would use this CAC and cost of acquisition model to help you with. So one more slide. So the easy, or at least relatively easy part of all this is to build the models. And to make it easier, if you shoot us an email or a LinkedIn DM after the webinar, we're happy to share these model templates with you. But as I hinted at earlier, the harder part is actually having the data to populate the models. And unfortunately, most growth and mid-market SaaS businesses haven't done a very good job thinking through their data strategy. And as a result, they would find it very difficult to construct these models. Again, this is why prepping the data room for investment or exit is often so painful. But we found that one of the best ways to improve your data posture is to actually start with these diligence models and then use them as the basis to do a gap analysis so that you can identify where your instrumentation and your processes are inadequate. And only then, by knowing that, can you as a leadership team put initiatives in place to improve your data posture. And until you have all the necessary data, you should still build these models, but just use assumptions, but be very clear in documenting what those assumptions are or the logic behind them, so that if you are in an investment stage and an investor's looking at it, and they say, well, why did you make this assumption? You don't just go, I forget, right? That's just not helpful. So you can build these models on assumptions. They're not nearly as valuable as when they're on historical data, but you should do it either way. Most of all, take action now, though, to get your data in a better place. Don't wait until it's time for an investment or exit, because by then it's too late. And as Kelly Ford inferred in the Data Room podcast, companies that can't pull good models together are presumed to be operating on gut. And that adds execution risk in the eyes of the investors, which decreases valuations by 30 to 50%. And one more final shameless plug. If you need help with all this stuff, this is in our wheelhouse. Reach out and we can jointly figure out if we can help you move the ball forward. Thanks for your time. We'll see if there's any questions. I'm sorry we ran over a little bit.
Thanks, Scott. I think we're a little over time for questions, so I think we're going to break here. But if anyone wants to contact Scott, you can reach out to him by email or LinkedIn. His contact information is on the screen. And we look forward to having you at our next webinar. Look for an email for us inviting you to the next episode in our Bridging the Gap Between Finance and Go-to-Market series. Thanks for coming. Hope everyone has a great rest of your day today.
Thank you all.